I did not get my first life insurance policy until I became a licensed insurance broker. Now, I'm not talking about the life insurance that you get through your job, because that actually does not belong to you. It belongs to your job. I'm talking about the policy where you are 100% the actual owner. I actually had been thinking about it for 4 or 5 years. And by thinking about it, what I mean is knowing that I should do it, but not really taking action. And the main reason why I didn't is because I felt like I needed to have more information and understanding of what my different options were before actually talking to a professional. Now, that was absolutely not smart on my end. I'll tell you why in a little bit. And the reality is that even though I said I was thinking about it, I really was not doing anything about it because I was not doing the research that I said that I needed to do. If you're here, congratulations, you are doing much, much better than I was doing back then, because you're actually doing the work to do the research. And even though it can feel like life insurance is complicated, yes, there are many options. Yes, there are many variations. This video could literally be 8 hours long, but that is not what we're gonna do. I'm going to break it down and simplify it, as in make it first grader simple. So by the end of this video, you are clear on what kind of policy is the best fit for you. And you can actually call someone right after this and get one started. If this is the first time that we are meeting, my name is Nobu Musakiwa. I'm a licensed financial strategist, and I help working professionals 40 and over save smarter and pay less taxes by leveraging cash value life insurance. If you want to work with me, my link is in the comments. Today, though, is not about cash value life insurance. Today is about regular insurance. Before I break down the types of life insurance for you, this comes up a lot in my conversations with clients. So I want to first take a step back and just clarify that you are not entitled to life insurance. You have to apply to get life insurance, and the company can absolutely say no if you do not meet their standards of insuring you. Think of it like your home. If you have a home and you have insurance on that home, the first time you apply to get insurance, the company is going to come and do an inspection or check on Google to make sure that your house is actually intact, it's not falling apart, and then they will say, yes, this asset is what we want to insure. And so when it comes to life insurance, your body is the asset that is being insured, and if your body is not up to standard, then the insurance company will say no. Put yourself in the shoes of the life insurance company. Let's say you're paying $1,000 a year and your policy is for $500,000. If you pay $1,000 on year 1 and year 2 you pass away, they have to pay out $500,000. And so for the insurance company, what they are looking at is this body a body that is worth our risk? Worth our risk means that you are not going to pass away next year, right? The insurance company is going to say yes to applications where they feel like there's a good chance that you're going to live pretty long. And so if there's a good chance that you are not going to live pretty long, then you have a higher chance of either not being able to get insurance at all or having very limited options to what kind of life insurance that you can get. So things that make you a high risk and make it where you have a higher probability of expiring sooner are like DUIs, misdemeanors, felonies, history of cancer, like history of stroke. Those are some examples where there's a higher probability that you are going to pass away soon. The insurance company is absolutely going to say no. Keeping that in the back of our minds, right? There are all kinds of variations of life insurance, and you on your part do not need to know all those details to decide on where you need to go. With all the different variations of insurance, it really comes down to 2 different options for you on the grand scheme of things. Option number 1 is you are going to do a temporary policy. A temporary policy will give you insurance for a limited amount of time. It could be 10 years, 20 years, 30 years. What your option is for how many years that policy can be is going to depend on your age. The big benefit of getting a temporary policy is it's going to be relatively cheap. The downside of a temporary policy is that at the end of your policy contract, whether it's 10, 10, 20, 30 years, you have to apply again to get coverage. Think of this like you are leasing a car, right? When you are leasing a car, you have it for a specific amount of time. Once that time is up, you make a decision if you're going to keep that car forever or if you're going to give it back to the dealer. Now, remember what I said earlier about your body being an asset and the insurance company determining whether or not your asset is up to par. Imagine you get your temporary policy when you are 40, and then now you are 60 and you want to get a policy again. The chances of you being in the same health in your 60s that you were in your 40s is probably not the best. Is it possible? Yes, but more likely than not, you have some things that are going on medically that are now going to impact you being able to get another policy. Second downside is that as you get older, your cost of your life insurance is going to be more expensive because the life insurance company is looking at risk, right? And the risk, they're questioning, is this person going to pass away soon or not? And now if you are 65, you are closer to the end of your lifeline versus if you are 40. And so your cost of insurance is going to be higher when you are older, even if you're in perfect health. Now, your other option, which you probably guessed, is to get a permanent policy. With the permanent policy, the life insurance company is guaranteeing that no matter when you pass away, whether it's tomorrow, in 20 years, in 50 years, they are going to pay out at the time of your death. So because they are on the hook no matter what, a permanent policy is going to be more expensive. While it is a good thing that you're going to be covered forever, right? Doesn't matter if you get a policy today, tomorrow you get diagnosed with cancer, and the next year you have a heart attack, 5 years later you have a stroke. It doesn't really matter. Your policy is going to stay in place because you're already approved, you are already in. But the caveat is that you are going to be paying more to have that coverage for your lifetime. Because this policy is more expensive, the downside is like you have money tied up going to this policy that you could potentially be using to invest elsewhere. Now that we're clear on the two major options that you have, now you gotta take a step back and ask yourself a few questions in order to figure out like what really makes the most sense. So the first thing you wanna be clear on is what is your main goal for this policy? So are you getting this policy in order to cover several years of income in the event that you pass away? Is the goal of this policy to cover paying off a mortgage in case you pass away? Is it supposed to cover like X amount of mortgage payments in case you pass away? Is the goal of this policy to just pass money down and not have to deal with the state taxes? It's important for you to be clear on what the goal of the policy is and to articulate that to the person that you're working with, because they'll be able to give you other options available to you that you may not be aware of and or advise you on whether what you want to do actually is feasible or makes sense. The second thing to think about is what your top priority is in your finances in general. You may like the idea of getting a permanent policy, but your top priority right now is to buy your first house. So it may or may not make sense to put a whole bunch of money in a permanent policy. You might want to first focus on saving for your house and doing that, or you might want to get a policy that allows you to save for that first house and get a policy simultaneously. But it's important for you to know like what is your main financial goal right now. Are you trying to save more? Are you trying to pay off debt? Are you trying to buy a rental property? The person that you're working with should be asking you this question because that will also give us an idea of how else you can leverage your policy to make that goal possible. Once you're clear on your goal for the policy and you know like what are you trying to do with your finances overall, then you can determine what your budget is for this particular policy, keeping in mind what your top goal is with your finances, right? So balancing out your top goal and also adding in this policy, how much can you reasonably allot to this policy on a consistent basis? And if that amount is relatively small, even though you may like the idea of a permanent policy, your budget in the end is going to determine and restrict what you can reasonably do. And so if the funds that you have can only fund a temporary policy, then your decision is, okay, do I get the temporary policy for now and then add a permanent policy later, which is perfectly fine. Just remember to do it sooner rather than later, because if there's anything that happens to you medically, or once you get to a certain age, that's going to impact your ability to get a permanent policy. Along with determining a budget is just thinking through your general financial stability. If you are not in a very financially stable position, a permanent policy may not be the best thing for you, because that requires you to commit to a payment long term, and also requires you to put more towards that payment consistently. And so if you're not in a place right now where you are stable, where you are saving regularly, where you have a good handle on your finances, a permanent policy may not be the best thing for you. It might be better to start with a temporary policy. Once you are stable, add in a permanent policy. Yes, you can have multiple policies. That is completely fine. As long as you qualify and as long as your income allows for it, you can have several policies. If we're going the temporary route, that's going to be term policies. If we're going the permanent route, that's going to be whole life policies or universal policies. There are different variations within those buckets. You don't have to know all those different variations. All you have to do is know what your budget is, know what you're trying to accomplish, communicate that with the person you're working with, and they can work with you to figure out what the best option is for you and why. Now, you probably have the same idea of how life insurance works like I did, and thinking that it only is useful when you pass away. But if I knew how to use life insurance while you are alive in this video, I would have gotten multiple policies way before I did. So make sure you check that out so you fully understand how banks, and most likely the company that you work for, if you work for corporate America, is using life insurance right now. I'll see you there.